Yes, what's good guys? Welcome back to a new video. So in today's video we're going to be breaking down liquidity one-on-one. So liquidity essentially is just the engine of the market. Whether your trade hits stop loss, whether your trade hits TP, it's all because of this concept here, which is liquidity. It's the main driver of price. And if you don't yet understand liquidity, then you do not understand the game of trading. It's that simple. So this concept is the reason why you get stopped out. It's the reason why you hit TP. It's the reason why you get stopped out and you're wondering what the fuck just happened. Okay, so what actually is liquidity? Now, liquidity is just simply big, large pools of stop loss orders. Essentially, they are orders waiting to be grabbed. And the only driver of price is when it moves to where orders are sitting. It's not just randomly moving, it's constantly looking for orders, whether it's buy stops, sell stops. And it comes in the form of buy side and sell side liquidity. So buy side liquidity is above all highs and sell side liquidity is below all lows. And it's the fuel that the institutions and the big players in the game use to drive price. So a good analogy I like to think of liquidity is the market is simply just a car and liquidity is the fuel that you put in the car. If there's no fuel or liquidity, then the market simply does not move. Okay, so why liquidity gets hunted? So have you ever been in a trade and as soon as you hit buy or sell, it just runs straight to your stop loss because you've put it at that obvious high or obvious swing low? This is what I'm about to tell you guys right here. So retail traders always trade at obvious levels. It doesn't matter whether they are buying above an old high, trying to trade a breakout, or below an old low, again trying to trade a sell side breakout, or maybe they are buying a retest of a specific trend line. It could be support and resistance concepts. So institutions need liquidity to fill massive orders. They simply can't just enter in a random price point with around 1,000 minis. They have to wait until price is above an old high or below an old low, and that's where they can enter the market. Think of all of retail's buy stops and sell stops above old highs and below old lows. All of these masses of retail traders all placing their stop losses in the same place. The institutions need to drive price into these large pools of liquidity so they can counterparty their positions and go short when retail are going long and vice versa. So your stop loss is their entry. You've probably found in many cases when you're going short, for example, you are taking a sell and you place your stop loss above a specific high. They are going to drive price above that specific high first and then go short, and then that's where you'll typically see the move. So price will always manipulate first and then move. So if you're analyzing the markets, you've got your daily bias, you've got a bearish drawn liquidity and you are bearish on the day. Always anticipate a manipulation move on buy stops, such as buy side liquidity above old highs. It could be a bearish fair value gap on the higher time frame. So always anticipate that manipulation move first above those highs, and then that is when you want to look for shorts. Look for that sell model, look for that inversion fair value gap, look for that optimal trade entry, look for that market structure shift with the fair value gap. But yeah, this is exactly why the market takes price above old highs and lows before the real move happens. They need large pools, large sums of money to counteract their positions, because those who are in the know, the institutions, smart money, they aren't entering with just one, two, three, even 10 minis. These guys are entering with hundreds, thousands of minis. Okay, so now we understand why liquidity gets hunted. Let's talk about where liquidity lives in the market. So the majority of places where you will see liquidity in the market, again, is above old highs, which is buy side liquidity, or below old lows, which is sell side liquidity. These are the two main points of liquidity. It is also found at equal highs and equal lows. These are where massive pools of stops hide, because if prices made one high and then it's made another high, retail traders are going to think this is a key point of resistance and they will take a short expecting those highs not to get taken. They'll place their stop loss above those highs and then smart money will just absolutely run through that buy side liquidity. Another point of liquidity is inside inefficiencies, so BISIs and SIBIs. Buy side imbalance, sell side inefficiencies, or bullish fair value gaps. Sell side inefficiency, buy side imbalances. Again, a bearish fair value gap. Liquidity voids and gaps in the market, opening range gap, new week opening gap, new day opening gap. If the level is obvious, it's a target. So if you're looking at the chart and you see specific equal highs and you already know that there will be large sums of orders resting above those highs. Smart money is simply going to target those equal highs, whether it's now or some point later in price. Okay, now let's talk a little bit more of buy side liquidity. So buy side liquidity is essentially liquidity that is resting above old highs. So it's a cluster of buy stops sitting above all highs. So if retail are going short, they are going to place a buy stop above a certain high, and you will also get retail traders who are placing buy stops above those certain highs, expecting a breakout, looking to take longs. So retail will look at these key highs in price and think if price pierces above that high, that is a valid breakout, and they will simply just enter long there. But institutions have known for years that retail have done this, and when they see a specific high in price, all they say is just liquidity. And then typically what you'll see is price will run above those highs to collect buy stops, and then they'll just dump price. This is called a liquidity sweep. So now when price runs above that high, all of those early retail traders who are in short have been stopped out of their trades at that specific high, as well as breakout traders are now entered in their positions looking to go long above the high, and their stop loss will be below price internal range. So with retail, it literally does not matter whether you're going short, whether you're going long. At some point, the market makers are going to take both sides of the market in one sitting. So what we do as smart money traders is whenever we see a key point in buy side liquidity get taken, we look for bearish setups. So you look for your inversion fair value gap model, you look for your bearish market structure shift with a fair value gap, you look for your unicorn model, you look for your optimal trade entry for going short. And real important, you must wait for the liquidity sweep to happen first. Okay, now sell side liquidity, it's just literally everything I've just told you guys, but the opposite. So liquidity resting below old lows, that is simply sell side liquidity. So sell stops stacking under equal lows or swing lows. Think retail traders who have already entered long, they are placing their stop losses below these lows, as well as retail breakout traders who are looking to go short below these lows. So retail will think that a breakout is coming below these lows and look to take shorts. Institutions simply see a discount in price. They've taken price below a specific low. They've attracted loads, thousands of buy stops, literally millions and millions of dollars to counteract their $1 million positions. And then price will run below these lows to collect sell side orders. So now retail traders who are going long have now been stopped out of their positions in a loss, and the retail traders who are going short below these lows are now in drawdown as price is reversing from these lows. So what can we do as smart money traders to take advantage of this? So whenever sell side liquidity is taken, we simply look for bullish setups. We look for a bullish market structure shift with a fair value gap. We look for an inversion fair value gap. Literally whatever your buy model is, only after the sell side liquidity has been taken. Okay, so the session liquidity trap. Every single session in the market creates a specific high and a specific low. Doesn't matter whether it's Asia session, London session, New York session, a previous New York PM session, a previous New York AM session. But all of these sessions every single day create a specific high and a specific low. So in retail eyes, they treat these levels like support and resistance. For example, if we get a London low and now we are trading inside of New York session, the retail traders from New York session who are specifically trading breakout models, they will look to see a break below that London low and then they will go short. But smart money sees that in the complete opposite lens. They see them as liquidity pools, not barriers in price. It's not a support level, it's not a breakout level. So one session's high and low becomes the next session's target. So say we are trading inside of Asia and we make a specific swing high and swing low, then we're going in London session. The London session is going to target either Asia high or Asia low, in some cases both, especially in the New York session. Say we've got a sweep of London low, then we'll look to take longs to London high. So price will sweep that liquidity below these session highs and lows, and then that's when you'll see the real move. Now the liquidity formula, which is the way I want you guys to see price, and this is the exact formula that I use every single day to take advantage of liquidity and liquidity sweeps. So the daily cycle goes like this. So number one, price is going to build liquidity. It's going to generate certain highs, certain lows. Doesn't matter whether it's Asia low, a London high, a previous AM session high. The market will simply create these obvious levels for retail to anchor onto. Again, breakout traders, early traders who are placing their stop losses at these specific highs and lows. Then number two, raid liquidity, which is called a stop hunt or a liquidity sweep. So a stop hunt or a liquidity sweep is simply when smart money takes the stops that are built up there or down there, whether it's a specific high or a specific low. Okay, so number three, we are looking for a displacement only after price has raided liquidity. So for example, the market makes a London low and now we're trading inside of the New York session. Price raids that London low and then quickly snaps back up in the opposing direction. So we've been seeing sell side delivery. London low gets taken. Now we're seeing that displacement to the upside. Then after the displacement and the market structure shift, for example, London low gets taken and then we break a swing high with displacement. That is your market structure shift. Now you're looking for price to rebalance into the imbalance, the fair value gap, or the breaker block, which is your refined entry. So if the algorithm is looking to take longs below London low, but they somehow miss that opportunity to take the long below London low, the fair value gap or the breaker block is their saving grace. That is where they will take their first entry. Then last but not least, you want to see a run to the next liquidity pool, which will be your TP. So if you see a raid on sell side liquidity and you get a buy model, price retraces into the fair value gap, you take a long or a buy. You're simply going to be targeting buy side liquidity, which is the opposing side of the current dealing range. So price always runs one side of the market, for example sell side liquidity, and then it'll reprice with sharp displacement straight to buy side liquidity. Now the one rule that saves you every single time, you never ever ever want to be entering before a sweep. So you always want to wait for the sequence in this specific order. So number one, liquidity needs to be taken. Then number two, you want to see that displacement, that sharp move. Then number three, you want to see a market structure shift, which is when price quickly breaks a specific high or swing low, again depending on the trade direction. Then last but not least, you want to see price retrace into the fair value gap or the breaker block, whichever comes first. Then that would be your refined low risk entry. Just like I was saying before, if the algorithm misses to take their long below a specific low, they wait for the retracement back into the imbalance in price, which was caused by the displacement. So then you'll see the algo reprice into this imbalance, and then that's where you'll get the sharp move to the opposing liquidity. So if any of these four aren't present, you do not enter the trade. Okay, so now I'm going to show you guys a few examples of liquidity sweeps and how you guys can take advantage of them. Okay, so this is actually an example of a trade that I took live with the Discord team, Tuesday the 2nd of December. So if you want to watch me trade live every single day, Monday through Friday, then tap the link in the description. I'm currently running a 3-day trial, so if that's something that you're interested in, watching me trade live, placing entries, setting the stop loss, setting the take profits, literally taking the exact same trades as me, then tap that link in the description and I'll see you inside. So this is NQ and a yes on the 15-minute time frame. We can see how a yes bumps below sell side liquidity. But if we take a look at NQ at that same specific low at 11:30 on the 2nd of December, NQ simply does not run that low. So that is the market telling us that NQ is more bullish and AS is just wanting to manipulate sell stops. So this is specifically called SMT divergence, where one asset between NQ and AS will sweep the liquidity and the other asset will hold below or above, depending on whether it's a swing high or swing low. So even though these markets are usually correlated, always running the same highs, always running the same low, whenever you are bullish and you see NQ not run the swing low, that is exactly what you want to see. So boom, number one, we've got the sweep on liquidity. We'll scale down to the lower time frames now. And we're trading from 9:30 a.m. Eastern Standard Time until around 11 a.m. Eastern Standard Time. So this 90-minute time window, this is where you're looking for the market structure shift with the fair value gap or the breaker entry. So we've got SMT divergence at the lows. And then what the NASDAQ does is it runs this internal range low. So price is fractal. Whatever happens on the higher time frames also happens on the lower time frames. So boom, NQ runs that low. Then what do we get? We see that sharp displacement to the upside, breaking this swing high. There's your displacement and your market structure shift. Now all we're waiting for is the retrace into the fair value gap or the breaker if we get a breaker. So Price actually creates a breaker in this example, which is why I went long inside of the breaker instead of the fair value gap. So took a long on the retrace into the breaker, stops were at the low, and we're simply targeting this buy side liquidity, which is the opposing side of the range. Again, whenever we take sell side liquidity, we always want to be targeting buy side liquidity. So retail are going long above this specific high, and whoever is short, their stop losses are going to be above this buy side liquidity in form of buy stops. So enter there, and you can see how perfectly the market moves simply because I understand the concept of liquidity. Other than fundamentals, it's literally the main driver of price. Okay, perfect. So here's another example, again, what I personally traded live with the Discord team in the live call. This time it's a sell model. So again, price runs above buy side liquidity, which is this higher time frame high. Now retail are simply looking at this point in price, and they're saying if price breaks above this high, I'm going to take buys, expecting that price is going to continue expanding to the upside. So we've had the liquidity sweep on the higher time frames, so now we are clear to go on the lower time frames and hunt for a sell model. So again, what are we looking for? We're looking for a sharp displacement in the opposing direction. So the market's been offering buy side, buy side, buy side until it runs out a higher time frame buy side liquidity level. Now we're anticipating a displacement in terms of sell side delivery. So we want to start seeing big bearish candlesticks print to the downside. And then boom, that's exactly what we got here. A nice and clean displacement. Do we break below a swing low? Yes, we do. Do we have a breaker? Yes, we do. Do we have a bearish fair value gap? Again, yes we do. So in the live call, I took a short as soon as price retested the bearish fair value gap, and I was just targeting the opposing liquidity, such as sell stops. We'll see how the price plays out. Okay, so notice how price didn't break this low. Early traders who are in this short are already trailing stops to the most recent highs. Now the market makers punish those specific traders before delivering the real move. So notice how price bumps above buy side once more, and then just notice the displacement straight to TP that we'll get right here. Just like that, guys. It's literally how the market moves. Buy side liquidity back to sell side liquidity. So if you're looking to watch me trade live every single day, Monday through Friday, take the exact same trades as me and just overall level up as a trader, then the link is in the description to join the Discord. If you want to take it a little bit more seriously and you want a mentor, so in the one-to-one, it's simply a 4-week program, and it's one call per week, specifically 60 to 90 minutes long. And on the call, I simply just break down your trades, saying where you went right, what you did wrong, where you can improve going into the next trade. And I'm simply just holding you accountable, whether you're sticking to your risk plan, whether you're sticking to your trading model, whether you're blowing account. I'm always there to help you. And all of the one-to-one calls will be recorded, so you can actually go back on the specific calls where I break down your trades, where I break down your emotions, where I break down your risk management plan. But yeah, if you are serious enough and that's something that you are interested in, again, link is in the description for my Instagram. Just message me on Instagram, DMing me the word mentor, and I'll send you more details. But yeah, other than that, guys, that is literally Liquidity 101. It's how the market moves. So if you found this video helpful and you learned something new, then please just drop a like, subscribe, and I'll see you guys all in the next video.